There are a few common questions that every single person has in their mind when they start their investing career. Questions like, how do you analyze a business? What makes a good investment? Or how do I become a better investor? There are a million different ways to answer these questions. And there are also a million different voices all trying to shout above each other in order to catch your attention. Do you listen to the Wall Street Journal? Do you listen to the Motley Fool? Do you look at articles on Seeking Alpha? Do you watch your favorite YouTuber or listen to your favorite podcaster and see what tips they have to give? Or maybe do you listen to your friend or your uncle, people from your family, your mentors? Do you look at 13F filings and look at what the pros are buying, like Warren Buffett and Terry Smith and all the other legends? Or do you look at bank analyst ratings? After all, banks have teams of analysts, and their entire job is to look at stocks and rate them as a buy, hold, or sell. Surely, if their entire job is to do that, they would have some idea of which stocks are good buys. Or do you look at our very own ratings on Rated A? The truth is that one expert will tell you one thing and avoid this, and the other expert will tell you, no, don't avoid that. You should do that and avoid the other thing. All of a sudden, it feels like you're a kid in the grocery store again, trying to pick out a cereal box for the first time. There's all these beautiful cereal boxes on the shelves, all trying to catch your attention. One of them has oats, one of them has honey, one of them is full of protein, one of them has chocolate. You have all these really appealing options in front of you, and it's easy to get a mental blockage at that point. And so, when you're just starting off your investment journey and all of these different options are calling out at you and saying, hey, these are all the benefits you'll get from following me, it can be very difficult to know who's right, who's wrong, who's telling the truth, and most importantly, who should I follow? The harsh reality is that nobody can give you the answers. If you ever want to make decisions for yourself, whether that's starting your own business or investing in the stock market, you're really going to need to take matters into your own hands. Understand a business so much that you can have the confidence to stand on your own 2 feet and say, I see it differently, whenever the market tells you otherwise. Because, yes, a great investor has the ability to look at financial statements and understand them, crunch the numbers, but at the end of the day, they also have the stomach to have a different perspective and a different view than the rest of the market. And that's going to happen very often during your lifetime. You just have to think of the extremes of market cycles when it's the most dangerous to be wrong, but also the most unpopular. Let's take the dot com bubble of the year 2000, for example. The market was just telling itself one story: the internet is going to change the world, and any business that has any sort of link to the internet should deserve an extremely premium valuation. You were seen as an outcast back then if you thought differently, if you stayed out of the internet.com names. And if we fast forward 8 years later to 2008 during the great financial crisis, we can see the other side of the coin. That was a moment in time when the entire market was very pessimistic, and everyone around the world was thinking the same thing. Banks are going to collapse, the entire financial system is doomed. Therefore, it is not a good idea to own stocks. You had to be a madman in those times to call up your banker and ask them to buy shares for you. They would have gladly done it, but they would have thought you were nuts. But it turned out that that would have been the best time to actually buy stocks, and you would have made a fortune over the next 15 years. So, yes, you can borrow ideas from your favorite influencers. You can always learn from others. You can always look at 13F filings and see what stocks Warren Buffett is buying, for example. And that can help guide you in your decisions. But the conviction that you need, that has to come from you. And now I'm going to give you 3 reasons why. The first reason is that there are so many ways to make money. The stock market's like a buffet in that you can choose exactly what you want to eat. You've got short term trades on news, you have momentum trading, you have swing trading, long term buy and hold, value investing, dividend growth investing, quality stocks, option contracts, day trading, technical chart reading, and those are just the appetizers. And you can make money doing any of the things I mentioned. As a matter of fact, all it takes is one quick Google search, and you can find various different people that have made lots of money using any of these strategies. I'll admit, it can all look very appetizing, but I hate to break it to you. You are not them. You are you. And sooner or later, you'll have to figure out what works best for you. What best fits your personality? Are you a patient type that doesn't like to look at stocks or keep up with the financial markets? Are you someone that's very into the adrenaline of looking at what's happening in the world every day? Are you someone that likes to generate income from their portfolio? That might be someone who's closer to retirement. Or are you more of a venture investor, someone that likes to place many different bets, hoping that one or two will do really, really, really well? What is your tolerance for risk? Are you younger, older? All of that will depend on your own personal case. If you end up picking a strategy just because someone is recommending it, then you're just setting yourself up for a very quick and painful and potentially expensive experience. At the end of the day, being a student investor is a bit like being in a restaurant, except that in a restaurant, you place your order and the waiter brings you the food that you ordered. When you're a new investor, the waiter is just going to keep bringing plates of food and you have to pick which one you want to eat. If you just accept the first one that looks good that the waiter is bringing, you're not really doing yourself the biggest favor. It's better to know in advance what you want to eat and then pick that once the waiter brings that to you. That's how you optimize for your best experience. The second reason why you need to develop your own conviction is that everybody has a different incentive. Charlie Munger once said, "Show me the incentive and I'll show you the outcome." It's very simple. Think about it. Anyone on social media, their incentive is to get the maximum amount of clicks, of watch time, and of subscribes. And what get the most clicks? It's the promise of very quick riches or the fear of total loss. Do one quick look on YouTube and you'll see that the most viewed videos on the stock markets are the ones talking about stocks that are going to go to the moon or when the economy and the market is going to crash. Those two themes by far get the most views on this platform. What about a fund manager? The incentive for a fund manager is just to collect the maximum amount of assets under management. It's not to beat the market, it's not to outperform the market and create the best returns possible for their partners. It's to convince these partners to add more money, to collect as much money as possible, and to manage the biggest pot possible. What about your financial advisor? Well, their incentive is to keep you just as dumb as necessary for you to think that they're doing magic in the background so that you don't question them and you don't question whether you need them managing your money in the first place. They just want to keep you around as a client because without you, they don't make money. At the end of the day, nobody cares about your money as much as you do. And that means you need to be informed enough to know when someone's advice is actually bad for you. Even the professionals fall for this. Investment bankers are very useful. The people that work for Goldman Sachs and Morgan Stanley, they're very useful when it comes to mergers and acquisitions. Usually, the company that is selling itself in the acquisition is willing to pay huge amounts of money to hire the best teams of investment bankers. Why is that? Well, it's just because that team is going to be able to bump up the price of the acquisition by several billion dollars. It makes a huge difference to the management of the selling company. And how do these investment bankers do that? How do they convince a buying company to pay more for the same acquisition? Well, they are able to tell a very convincing story, a story that usually has to do with incredible growth in cash flows or fear. They tell the buying company that the one they're trying to acquire is going to disrupt them and take away market share if they don't make this purchase. This dynamic is really well documented, and it's one of the major reasons why acquisitions end up destroying value for shareholders in the vast majority of cases. The third and final reason why you need to develop your own conviction is that in the stock market, disagreement is a superpower. The stock market is a bit like betting on sports. If everybody believes that the same team is going to win, then the odds and the payout becomes terrible. Real Madrid is one of the best teams in the world. They have a star-studded squad, and it's very difficult for any of the smaller teams in Spain to ever beat them. The result is that whenever Real Madrid plays a small team in Spain, if you bet on Real Madrid winning, your payout is going to be tiny. You can be right, the team is going to win, but you're not going to get a big return on your investment doing this. And the time that they do lose, you'll end up losing very big. In other words, you can still be right in the stock market by figuring out which company is the highest quality or will have the most growth in front of it, and still make very little money because that optimism is already baked into the price. The magic happens when you see something that everybody else misses. To go back to the football analogy, it's like knowing in advance that the star of the team in Real Madrid is going to be injured and that the smaller team actually has a much bigger chance to win. If you're right, now the odds are stacked for you, not against you. The biggest wins in sports betting and in the stock market come from seeing things that others can't or won't see and having the guts to back yourself when everybody else thinks otherwise. Yes, it's very uncomfortable. Nobody likes to be the one penguin waddling the other way when the entire tribe is going the other way. But if you've done the work and you build the conviction, then that's where the real wins live. The point of making this video is to urge you to become a skeptic. When you're asking big, important questions like, how should I invest? The worst thing you can do is to blindly trust anyone's opinion, anyone's advice, mine included. In business and investing, that's the fast lane to losing money. Instead, I urge you to hunt for your own truth. Build your own conviction so that you can stand on your own 2 feet while everyone else is swaying in the wind. If you like this video, make sure to subscribe to this YouTube channel. I post videos like this every week. And if you like educational content like this on investing, make sure to sign up to the Signal newsletter. I'll leave the link in the comments below. Thanks for watching, and I'll see you in the next one.